morning, everyone. Welcome to our earnings call for fiscal year 2020. And I hope it's not too late to greet Happy New Year to everyone on the call. We wish the very best for 2021. Join with me in the room are four executives. We have Kun Vipan, our president. We have Kun Anucha, Chief Risk Officer, and Kun Manop, our CFO. We will have Kun Sarat, another president, be joining remotely on the call. So we have a full team to share with you the results and also answer any questions you might have. There are a number of topics. We released the result last night along with the materials. I hope you guys have a chance to kind of read through it and we can get into the discussion. We will have a number of topics to cover today, so let's get to it. We'll have Kun Manop, our CFO, kind of talk through the results, and then we can open up to Q&A. Please go ahead.
Thank you, Dr. Arak. Good morning, ladies and gentlemen. I hope you all have the presentation in front of you right now. Let me first give you the latest update of our relief program. By the end of last year, the loan outstanding under the relief program dropped to 402 billion baht. And this accounted for about 18% of our total loan book. So it has been declining for two consecutive quarters already. So versus the initial 839 billion baht, effectively, roughly 440 billion baht of customers have exited the program in the second half of the year. And the outcome has been quite satisfactory. Around 70% of customers was able to come back and service their debts. So a little bit over 30% essentially sought further assistance from us. The risk is with the second group of the customers, but we believe the ultimate impact would be manageable. Our assessment is that more than 90% on a combined basis of the customers who exited the program are making good progress in terms of servicing their debts to the bank. To reflect on the relief program, we believe the outcome has been quite satisfactory and is basically meet the better end of our expectation that we set out early on in the second quarter of the year. We have been quite proactive in terms of providing assistance to our customers, and we also adopted a prudent approach. We put in place last year a new risk rating framework, which has a more detailed risk gradings, and also take into account behavioral aspects of our customers so that we better understand our customers. And that's why we came out to be a satisfactory outcome of the relief program. Now, for the customers who remain in the relief program, which was about 402 billion baht of loan outstanding, there is a new factor at play at the moment, as Thailand has been experiencing second wave COVID since a few weeks ago. On the one hand, the government lockdown measures have been rather mild. In Bangkok, essentially, we would say that there are no lockdowns. But then in the deep red zone provinces, the government adopted a soft lockdown approach. So economic activities are still ongoing. But on the other hand, the number of cases and the geographical spread has been much more severe than last time. So we are in the process of assessing the impact of the second wave to the remaining of the relief program. The risk is that there could be more customers seeking further assistance from us, or even new customers come to us and requesting relief programs, as the Bank of Thailand already extended the relief program deadline to the middle of this year. So we are reopening the relief program to our customers. So far, we can say that the number of new entry into the relief program so far has been quite minimal. But we would like just to be cautious and prudent when we approach this second wave crisis. In terms of asset quality, we want to ensure we have good asset quality on our book. In the fourth quarter of this year, we continue to do qualitative NPL recognition. we basically conducted a very comprehensive review of our customer portfolio, both in the relief program and those in the non-relief, in the normal portfolio. And we recognized about 12 billion more of the qualitative NPL, which I will mention in more details when we talk about that numbers in the result in the later slides. In terms of NPL management, we believe we should adopt a value preservation strategy when we come to NPL management. So we are not in a rush to get rid of our NPLs because we believe that we will be better capture value sometimes down the road. So NPL has been rising in the fourth quarter, but nonetheless, we'll make sure that our NPL coverage level will remain at a very comfortable level. Please move on to the next slide. Next slide, I just want to give more color in terms of the remaining breakdown, the breakdown of the remaining customers in the program. Of the 402 billion baht in the remaining program, you can see that the majority of the reduction came from retail segment. So right now, about 177 billion is in the corporate, and 106 coming from SME segment, and 119 in the retail. Versus our overall portfolio, perhaps SME segment made up the highest number. So SME roughly is about 30% of our total port remain in the relief program. But then the number is lower for the corporate and retail segments. As I mentioned, we are assessing the impact of the second wave to our remaining portfolio program. But we want to share with you some of the data points so that we all understand the risks or the eventual impact, potential impact to our relief customers. Of the corporate and SME segment, roughly about 28% is in the hotel segment. So now we all know that hotel is the most vulnerable segment in this crisis. But we also want to emphasize that actually most of the hotel customers are highly collateralized. In the retail segment, 80%, over 80% of our customers in the retail, in the relief program, actually is our secured loan. So predominantly mortgage and also auto hire purchase. So just to give you a flavor of in terms of what is remaining in our relief program. In terms of the moratorium split versus debt restructuring split for the remaining program, for the remaining customer in the relief program, roughly speaking, corporate and SME segments, the moratorium groups of the customers made up about 20 to 30%, whereas for the retail segment is on average about 60%. So we do have a little bit higher moratorium in the retail segment, but then the retail segment actually has been performing quite well. The number of retail segments in the relief program is actually quite small. Now on this slide, page 4, we also would like to highlight what we are seeing on the ground and share with you what is happening to our customers' portfolio. One thing to note is that our Economic Intelligence Center has recently downgraded GDP for this year down from 3.8% to positive 3.8% to 2.2%. So as I mentioned, we adopted a rather cautious approach to this pandemic. And after all, actually the Thai economy was quite slow already even before the COVID crisis. So we want to be proactive, yet prudent in terms of approaching the customer who need help. However, we want to emphasize that the relief efforts this time will be more targeted, will be more selective, as opposed to across the board that we did last time. The most vulnerable segment, we would say, would be within the SME segment. About 9% of SME customers is in the deep red zone provinces, the 5 provinces that the government highlighted as highest risk areas. So there could be more possible more soft loan programs coming in, and that could be some margin pressure to our SME portfolio. Retail, some customers may adopt a wait-and-see approach, so there could be some impact to the spending and so on and so forth. But nonetheless, investment-related products would remain quite resilient under current liquidity environment. Corporate segment would see a relatively milder impact, some delay in projects, but we don't think that that's going to be a big major issues. So we will continue to provide support to the customer where needed. We continue to adopt a rather prudent approach. We also want to highlight that within this crisis, we try to protect downside. We try to manage our balance sheet on a prudent basis. But at the same time, we also want to capitalize on this crisis. We not only want to survive in this crisis, but we also want to come out stronger when COVID is gone. So some of the initiatives that we took last year in response to this crisis, we launched two major digital platform, Robinhood, which is a food delivery platform. This platform is mainly for small restaurant operators to be able to enjoy the digital platform. And we basically do not collect GP from our merchants. And another platform that we launched in April last year was SCB Shop Deal that allows SME to be able to sell their travel-related packages to the market via our marketplace. So in a relatively short time span, we have been able to add over 900,000 online users to our new platform, and we are transacting over 11,000 orders per day. So on a combined basis right now, SCB is offering multiple digital channels at the moment, multiple digital platforms, including SCB Easy, which is our main mobile banking app. Altogether, we have added 3.4 million new digital customers last year, which is over 30% increase. Now, our total number of digital users came up to 13.7 million users. So I think we just want to highlight that we will continue to do more in terms of digital initiative, and we should see more progress over the coming years in terms of building ecosystem to allow us to have better digital engagement with our customers. Now let's move on to the next section of the presentation, where I would like to highlight the results of last year as well as the 4Q results. On this page, you will see the key major developments last year and in the fourth quarter. I will have detailed slides for each of these bullet points, but let me quickly summarize the key important issues here. First, everyone knows that 2020 was very tough. We spent a significant amount of efforts to try to protect our downsides with a prudent and proactive nature to support our customers. We tried to manage what we can manage. We grew non-NAI 12% year on year versus the flat growth target. Predominantly, our banker business has been significantly outpaced the market growth, and our wealth management business was also quite strong with our new service models. So this strong non-NAI growth helped us to offset the decline in the NAI, which dropped 3% on a year-on-year basis. And the pressure on the NAI is basically coming from interest rate cuts and our strategy to focus on the quality sectors of our customers. Loan growth, quite decent, plus 7% year-on-year, and mainly driven by corporate loan demands, and a little bit from the soft loan to our business customers. So when we look at the operating profit, up 12% year-on-year, and this is also because of we manage our operating cost really, really well. Our CI ratio declined to mid-40s, and we have better cost efficiency from digital channels, and we also managed to close our branches, 147 branches that we closed last year, and we will continue to manage down our costs and restructuring our cost base to be more efficient. Provision remained elevated, 214 basis points for the full year, and in the fourth quarter, which I will highlight it in more details later, over 250, around 257 basis points for the fourth quarter. And this is just a matter of prudent and to provide comfortable cushion against future uncertainty for us. New NPL formation, which basically in the fourth quarter, we loaded in more qualitative NPL. So NPL stood at 3.68%. This is because of the qualitative downgrade. And as I highlighted early on, the qualitative downgrade was from both relief and non-relief sectors, so that we, as a matter of prudent and proactive to our asset quality. Our capital position remained very solid. And the last point that we want to highlight is on the dividend payment. In November last year, the Bank of Thailand issued an announcement that allowed banks to be able to pay dividends out of 2020 profit. However, the payout ratio should not exceed the payout ratio of 2019, nor should not exceed 50% of current year net profit. And we would just want to highlight that it happened to be the case that in the year 2019, the definition, by definition of the Bank of Thailand, this payout ratio should be calculated based on bank-only net profit. And it happened to be the case that in 2019, our bank-only net profit was a little bit different from, was quite different from the consolidated net profit. So we just would like the market to take note of that. For us, we would just comply with the BOT's regulations. This page just to give you a highlight. But so let me jump to page 9, where we will discuss in more details about on a quarter-on-quarter comparison and on year-on-year comparison. Let's look at 4Q numbers on a Q-on-Q basis. The notable increase was from non-NAI line. Recurring income was up 26% on a quarter-on-quarter basis and 24% on a year-on-year basis. Banker and wealth management was the main growth contributor in this growth. Operating expense dropped 13% year-on-year, even though ticked up a little bit on a Q-on-Q basis. It's just some seasonality that we see some OPEX reimbursement towards the end of the year, and also as activities picked up post the lockdown in the third quarter. But the overall OPEX is still within our control and within our full year budget. PPOP, pre-provisioning operating profit, up 8%, quarter-on-quarter basis, and up 23% year-on-year basis. So 20.3 billion baht for the fourth quarter. So that's what I mean by we try to manage what we can manage, and we want to protect our downside, and we make sure that at the operating level, we still have a rather solid performance. Provision, we decided to add in a little bit more provision in the fourth quarter of the year. First, to cover the qualitative NPL that we, the higher NPL that we had in the fourth quarter, and also given the fact that we have COVID second wave that is ongoing right now, and the number of cases are quite much more severe than last time. So net profit for 4Q, around 5 billion baht, up 7% Q-on-Q. On a year-on-year basis, what we want to highlight is basically non-NI continue to be good growth on the recurring line. So that's give us operating profit up 12% year-on-year if we exclude the one-off items from last year as a result of the SCB Live transaction. So we believe this is rather solid performance from us, in particular from at the operating level. NII. In the fourth quarter of this year, the net interest income on a year-on-year basis, that's because we divested SCB Life, so it's not so much comparable. But let's look at on a Q-on-Q basis. Still, on a Q-on-Q basis, is plus NII lending minus 1% Q-on-Q. We still continue to be under pressure because of the NIM. So we just want to make sure that we try to manage our NIM, but the pressure is still there. And in the this year, 2031, when we realize the full impact of rate cuts from a series of rate cuts from last year, so NIM will continue to be under pressure. So let's move on to the next slide, where we want to highlight NIM on overall basis. NIM in the fourth quarter dropped 10 basis points to 3.02, and in terms of breaking it down, as a result of rate cuts across the segment, minus 14 basis points. EIR, actually, delta EIR give us plus 5 basis points, and we have some negative impact from the loan mix because we have the flight to quality strategy, and also because of the LD ratio, which has been quite low last year. We believe there would still be some pressure in terms of the NIM going forward, but we will try to manage our NIM, and later on we want to discuss the NIM outlook in more details. We also try to manage down cost of deposits, but nonetheless, the overall impact is still under tremendous pressure in the fourth quarter. Breakdown, yield on loans are breaking down by segments and by products. Overall, yield on loan dropped 17 basis points Q-on-Q, most notably coming from SME segments and also the corporate sector. SME, partly because of the soft loan, and also some of the customer has been quite weak, and also restructuring of the SME customers. Corporate is basically as a result of our flight to quality. Retail has been quite resilient, but within the retail segment, we see a little bit of a drop in the unsecured segment because of the BOT new guideline. Auto and housing has been rather resilient in terms of the yield. Loan growth. Most of the loan growth contribution was coming from corporate segment. In the 4Q last year, corporate loans up 8% Q-on-Q. We had a sizable major deal, a corporate deal that we booked in the fourth quarter, and we also had some other deals that came in towards the end of the year. So we managed to grow corporate loan decently in the fourth quarter. SME stable on a Q-on-Q basis. Retail loan has been, I would say, quite resilient in housing and auto sectors. We want to make sure that we continue to focus on the good segments within these products. For housing, we are working more and more with top developers. For auto, we also focus on the high quality brand, and also with our partner dealers, so that we ensure that the asset quality will be there. NPL. In the fourth quarter of last year, new NPL 20.7 billion baht, an uptick from 3Q. Of the 20.7 billion baht, roughly 60% was coming from qualitative NPL recognition. And within that qualitative NPL recognition, which came from both relief and non-relief, the majority was actually coming from SME segments. And we believe that with the pandemic that is ongoing right now, the SME sector remains the most vulnerable sector. So that's why we loaded in more NPL in the fourth quarter of last year. And this is just a matter of prudent and also proactive practice for us. So total NPL in the fourth quarter, 3.68. Corporate NPL stable quarter up a little bit because we also had some qualitative downgrade for corporate segments, 3.99% in the fourth quarter. SME jumped to 11.4%. We would say if we strip out the qualitative downgrade, the percentage NPL for SME segment would fall back to high single-digit range. Housing and auto loans NPL remain rather stable on a quarter-to-quarter basis. Our provision, the way we look at provision is that we want to maintain comfortable cushion against future uncertainties. Our operating level is to have NPL coverage above 130%. In the fourth quarter of last year, it was 141%. And the credit cost on a whole year basis, 214 basis point. On the fourth quarter, 257 basis point. We believe this is just for us to adopt a prudent approach and have enough protection against future uncertainty. Going forward, we kind of see that the level that we saw in the third and fourth quarter of this year should already be at the peak level. We later on in our guidance, we would like to mention that we are guiding for NPL on the whole year basis for this year would be below 200 basis point. We kind of see that the risks arising from the NPL from the COVID would still be high. There's still lots of uncertainty, but our protection against future uncertainty should be already be quite enough. So we can discuss in more detail when we talk about our financial guidance. Non-NAI is the main growth engine for us last year. In particular, the recurring non-NAI up in the fourth quarter, up 24% year on year and up 26% on a quarterly basis. Let's look at the breakdown in the following page. Of the non-recurring income in the fourth quarter, can we move to the next slide? The most notable increase was driven by bank card business and followed by wealth management. Let me mention a few words on the increase in the bank assurance business. What happened in the fourth quarter is that we booked a performance-linked bonus from our partner. And this bonus is based on certain performance targets that we need to achieve. And we came to conclusion with our partner that we came to conclusion that we could achieve the full year targets, and we recognize the full year performance bonus in the fourth quarter. So going forward, in a way, one should expect that we're gonna spread that out. Once we know that we achieved the targets, then we would spread it out on a quarterly basis going forward. We have confidentiality agreement with our customer, but what we can say is that this performance-linked bonus or compensation was given to us by our partner in order to jumpstart the business under the new partnership model. And this is just for the first few years. So we should continue to enjoy this in 2021. So that's basically mainly the main contribution of bank card revenue that we saw a good growth in the fourth quarter. Wealth management also increased quite substantially on a year-on-year and Q-on-Q basis, partly because of the very strong market in the fourth quarter. But also we conducted a program towards the beginning of 2020 to uplift our wealth relationship managers' capability from service-oriented into a more professional advisory model. And we look at the whole service chain from customer acquisition all the way to performance monitoring. And let me show you in the next slide that for the wealth customers, we managed to grow our customers and also asset under management. So that's basically contributed to the good growth in the wealth management. Back to the chart on the left-hand side, you can see that despite of the market down, and this we want to show new business premium in life insurance, overall market actually dropped 10% year on year, but our new business premium increased over 40% year on year. So we spent lots of effort to try to grow the business that we can manage and to add to the value and to protect downside to our bottom line. OPEX is at the very core of our focus management last year, and which will continue this year. In the fourth quarter, it's up a little bit Q on Q, but on a year-on-year basis, it's still falling 13% year-on-year. On a full-year basis, our OPEX came in 64.3 billion baht, dropped 9% year-on-year, and the decline has been in the employee segment, premise and equipment, as we closed down 147 branches. Marketing also dropped 24% year-on-year. So this, the management of the cost base is an ongoing effort from our digital transformation that we did over the past few years, and we started to reap this benefit. Certainly, this crisis helped us expedite the digital transformation, and we believe that this momentum should continue in the year 2021. So our CI ratio in the fourth quarter stood at 44%. Is coming down from over 50% late last year and down to 44% this year. And this is basically in line with actually better than our target. We set the target at around high 40s, and we came in at about 44%. Liquidity remained very strong. In fact, our LD ratio 93% at the end of the last year. It's moved up a little bit from 90% in the third quarter as activities pick up, and we also try to manage our balance sheet. So we believe that this is an area that we can improve in terms of balance sheet or LD ratio optimization going forward. But in terms of liquidity ratio, deposit base, we believe is still very solid. So that's no concern for us, but there's room for us to optimize this balance sheet structure. Capital base, total CAR 18.2% and CET1 17.1%. We believe this is among the highest in the banking sector, and we continue to make sure that our capital base remain solid, and we will continue to strengthen our capital base in order to make sure that we will go through this crisis and come out still very strong. And I think just a note on the dividend that I mentioned early on. Financial guidance. Our macroeconomic team downgraded or revised down GDP to 2.2%. Is mainly predicated on slower tourists coming in into Thailand, and the Thai economy is largely rely on external factors. But within this revision, we still see that the policy rate to be maintained this year. So there's no change to the policy rates. And just take a look at some of the quick high frequency data. On the right-hand side, you can see that activities in terms of high frequency movement dropped quite dramatically. in the first few weeks of the year. Actually, the decline started from the last week of December already. But one point to note is that even though it is not as low as the previous outbreak, but still the drop is quite significant. So that's why we would like to monitor this space, and we want to exercise cautious and prudent approach when we look at this second wave crisis. Financial targets. The overall theme is we want to adopt brace for second wave impact approach. So this guidance is basically based on somewhat impact of the second wave pandemic. Loan growth 3 to 5%. Essentially, we still continue with our flight to quality strategy. We still believe that good customer segments, good to grow segments within each of the customer segments that we can pursue. And we believe that 3.5% is a modest growth, moderate growth, should be fairly achievable. NIM continue to be under pressure. We are looking at 3 to 3.2%. Some efforts has to be made from our side in terms of balance sheet optimization and to ensure that we continue to maintain our NIM at above 3.0. Non-NII growth, we will continue to focus on banker, funds, and wealth management. As I mentioned early on, our banker, we look at to improve our product mix from previously more in the saving products types. Now it's an ongoing process for us to improve the mix to more protection and unit-linked types of products which are higher value. In wealth management, we continue to see good momentum in our wealth management business and also fund investment. So within the flat growth on the overall non-NAI, we looking at recurring non-NAI to grow at a mid to high single-digit growth rates. Cost to income ratio, we are targeting an improvement in the cost to income ratio and on the back of continued cost structure transformation and better efficiency gains from the digital channel, so low to mid 40s. On NPL, we kind of see that right now we are not in a rush to sell NPLs because we believe we will be able to better capture the value down the road, and also as the more and more new NPL supply coming to the market, we will not be able to realize good value at the moment. So NPL on an overall basis will rise. We are guiding for a rather wide range because we need to manage and also assess the environment and situation as we move on. So 4 to 4.5% range, but at the same time, we want to make sure that we'll have enough coverage on our NPL. So on the NPL, we will continue with our prudent NPL recognition and also management. Credit cost, we are looking at less than 200 basis points. So the credit cost in the year 2021 should not be more than this level. So it's kind of peak already. We believe it's kind of peak already last year, which we saw 214. The way we look at this is that if the relief portfolio was any guidance, I mentioned at the beginning that over 90% of the customers are making good progress in terms of debt servicing. So that leaves us with less than 10% of the customer that could be at risk. But of course, not all of those will be NPL. So if that can be any guideline to the overall portfolio, obviously the non-relief portfolio should perform better than the relief portfolio. So if we apply high single-digit eventual NPL to our overall loan book, we believe that the coverage, the credit cost of less than 200% should be enough to maintain reasonable coverage ratio over the NPL that we have. Coverage ratio, we are looking at above 130%. So this is basically just a cushion against rising risks from the pandemic and also the expiration of the relief programs. Most of the customers will see that relief program expiring throughout the year by middle of this year. So 130% should give us a good enough cushion for the coverage ratio. So that concludes the presentation on my part.
Okay. So on the strategy update, why don't we just go page 32? Can we go to page 32? I'll just be brief on this one because I think we supply you with the materials already. And the point is that we maintain our core strategy. I want to show you this page on a little bit of a, kind of look back on the transformation journey, which actually set us up for the past year, 2020, and, kind of into the future. We've gone through a transformation program. We upgraded underlying infrastructure, put in new capabilities, and, adjust a lot of things, cost rationalization, things like that you've seen. In the past few years, we've actually undertaken going upside down strategy where we focus on digital and build digital capabilities and data capabilities and start to think about bank as a platform beyond just traditional banking. Now, looking ahead, I think the two themes, right? The first one is really because of the COVID, because of the pandemic, we will have to focus on navigating this economic crisis where we need to be prudent on the portfolio management. The credit and the risk undertaking will need to be on balance. And so we need to be quite disciplined on that one. And things that we cannot quite control is how the market will evolve and the, kind of the response and the overall growth. But what we can control is definitely on the cost. So we'll remain disciplined on the cost rationalization where we continue to migrate the customers into the digital and therefore lower overall cost to acquire as well as cost to deliver. Now, the important thing is that with that crisis as a backdrop, that's something that we must do. But at the same time, we do not lose sight on the long-term growth, which is the number 2 yellow part on the top right, where we focus, continue to put double down and the emphasis on growing the wealth and insurance business, which you've seen traction in 2020. And certainly that's something that we will continue to focus on. And we've put in place new channels as well as new products. And, we fine-tune a lot of things that we've done in 2020. So hopefully that will still set up us up well for 2021 and beyond. At the same time, we also look further down the road, not just in the 1 to 2 years, but think about how the digital landscape will change. You see us say and do a lot more in terms of digital, where we've been put in place a concept of digital bank. We've undertaken SCB 10X to look at innovation, kind of future technologies such as blockchain, analytics and all these things. So you see us doing a lot of that. Now, it might not yield near-term results, but certainly these are the kind of capabilities that will set us up well in the future, much the same way that when we talk about transformation a few years back, we put in data capabilities and, kind of digital infrastructure. It took a while before that started to yield results that we start to see now. Hopefully, this will set us even better in the longer term. At the same time, we also recognize that as in any crisis, there will be opportunities. We look for consolidation. We look for inorganic growth. We can't quite say exactly where these things will pop up, but certainly we put a heavy radar scan on the potential acquisitions or significant investment in either in the banking industry or in the adjacent industries. And, with the new, not new anymore, Bank of Thailand has issued the technology, kind of IT services policy where bank can start to expand into technology areas that would allow us to actually certainly widen the scope of our scan. So that's something that we'll continue to do so. Hopefully we'll start to be able to, kind of build this as new growth engine in addition to our core growth engine on wealth and insurance as well. And last but not least, I think, despite the crisis that we've seen, the real crisis for banking industry, not just for us, is the digital disruption, and we cannot lose sight of that. You've seen us transforming our workforce, build new capabilities, and rationalizing the workforce. The number of people might come down, but we need to also build up the new capabilities, the new kind of culture that would actually set us for the long term. I'm less worried about kind of traditional banking industries and services where I think we will we know how to run that. We just need to be disciplined and efficient and be patient about how we survive through the crisis and grow what we've said. But it's really in the long term that we still need to build these capabilities. Again, the yellow boxes, some are short term, but a lot of them are long term. But hopefully that will give you a guide in terms of how we see the future. We see a lot of digital, we see new capabilities, and these are something that we must put in place when we have been putting in place, and we continue to put in place these new infrastructure and capabilities to set us up in the long term. So, and then we subsequent pages talk about how digital migration happens and, some of the activities that we've done. I won't bore you with the details because I know we have about a little over an hour left. And I'm sure you have a lot of questions in terms of 2020 as well as the outlook for 2021. So with that, I'll close the kind of strategy, highlight, and overview. If you have any questions, you can always inbound us to the IR team. They can always respond to the questions. And if need be, we can always organize, kind of separate session for that.